Do you see the slide?
Yes. Should I see?
Mm-hmm.
I'm sorry.
Oh, you should see the slide. Got my screen share. Oops, no, it's off. No, it's okay. Let me try this.
Sure.
I know, but it's you're not going to see. Look and see if you see that. See if you see this full screen.
Well, it's still me over there, so it hasn't come up yet. I'm still not seeing it. What's going on?
So I'm just going to go ahead and get started. Sorry, everyone. Good morning from not so very sunny Atlanta. We are trying to get our slides up, and hopefully if you can use your chat and let us know if you can see the slides. You should see a big screen with slides, and you should see me really small, hopefully. And if not, then we'll see if we can't get that remedied. But either way, we want to be respectful of your time. So we're going to go ahead and move forward. Basically, today, we're going to talk about how to manage cash flow when your customers won't pay immediately, which for a lot of us is fairly often. Some of you joined us in the last couple of weeks. We've been doing these webinars now for a few weeks. And a couple of weeks ago, we did one on how to grow your business. What was interesting about that webinar is what we heard from folks is it was not getting customers that was their biggest challenge. It was having the capital and the capacity to deliver to those customers. And then a couple of weeks ago, we did another webinar on risk. And what really surprised me there is we heard from folks that 75% of the folks that were on the webinar have been victims of some type of cybercrime. So clearly, as a small business, sometimes we think we're not big enough to be targeted, but there's really a lot of focus out there from criminals trying to target small businesses. So if you didn't attend that one, you may want to email us and let us know. We'd be happy to share the recording with you. So a few housekeeping tips. As I'm going through the slides, feel free to ask questions as they pop up. You can just type those in your chat window. And Sarah, who's moderating, will be happy to either answer those or we'll share those with everyone and answer them at the end. We are also going to, as we go along, put up a couple of different polls so that we can get a sense for some of the challenges you're having and how we can best focus our time. So without further ado, let's talk about managing cash flow, which is, if you're a business owner, should be one of your favorite topics. Today, what I want to do is three things. I want to first challenge the way that we think about cash flow and about working capital. These are terms that are thrown around every day by business owners, by bankers, by investors, by lenders, by customers, by partners. And sometimes when you say a word too often, you stop thinking about what it really means. So we're going to challenge that a little bit. The second thing is we're going to look at the different causes of working capital problems and which solutions best address the problem based on the cause. Again, when we get used to saying something over and over, we start to think there's kind of a one-size-fits-all solution, and that's absolutely not true. So we're going to go into what some of those solutions might be. And thirdly, I'm going to share with you an innovative new payment tool that allows you to get paid immediately in a way that feels like taking a credit card, so you no longer have the stress of managing cash flow problems, and you don't have the risk that comes with things like loans and factoring. So let's start with what is cash flow and what is working capital. Now, I know many of you are rolling your eyes because you're very financially savvy and you know what those words mean. But humor me for a minute as we just step back and reduce them to their simplest form, because sometimes your depth of knowledge is what keeps you from seeing new opportunities. I've found that often with my own business. So when we think about cash flow in the most simplest form, cash flow is the money that is moving in and moving out of your business during a given time period, typically a month. Working capital is the capital that your business uses in its day-to-day operations. Now, I know there's technical ways to calculate that, your current assets minus your current liabilities, but what's most important is to think about cash flow as the money coming in and the money going out, and working capital is the capital that you need to operate your business on a day-to-day basis. Now, if you're like me, oftentimes you think that your working capital isn't working so well for you. And what is really causing that? If you think about money moving in and money moving out, for most of us, money moves in one of three ways. You can raise money through equity, give away ownership in your company. You can borrow money, which is obviously money coming in, or you can sell a good or service and earn the revenue from that. Obviously, the cheapest capital that you can possibly fuel your company's growth with is your cash flow from operations, the money you actually made that comes in as revenue. It's interesting when you think about how different businesses get paid. If you were to go back to the 1950s or even earlier, and you were to ask yourself, if I owned a store or a restaurant, how would I get paid? Well, you can see in this image from that time period that this store owner is selling some products to this woman and her small child, and she is probably going to get paid in one of two ways. Either the woman is going to hand her cash, if it was maybe the day after payday and she's got some cash on hand, she's probably going to hand the store owner some cash in exchange for her product. But more likely than not, what she is going to do is she's going to have an account with that retailer. It's a little house account. The store owner has a ledger that they keep every month, and that woman is going to come in and buy some sugar or some clothing or whatever this merchant happens to sell, and she's going to walk away with the product, but she's not actually going to pay that day. She is, however, going to keep a tab or an account with that merchant, and at the end of the month or periodically throughout the month, she'll come in and she'll make a payment. I remember when I was a little girl and I would buy something, you would typically do it on layaway, similar thing, where you can actually walk away with the product and you're going to pay the merchant later. Interestingly enough, in this case, the retailer, the store owner, is the one giving you credit. It's not a bank or a financial institution. It's actually the store that you shop at. Now, fast forward to today. If you and I were shopping at this merchant, we are most likely not going to hand her cash. We might write a check, although that is rare. More likely, we are going to hand her a credit card, or we're going to scan our phone, or we're going to swipe something or scan something. We're going to leave the store with the products that we bought, and that retailer is going to get paid today. They're not going to wait for us to come in and pay our account in a few days. they're going to take that credit card or that phone swipe as payment, and they're going to get paid tonight. So when they close their doors, they're going to have been actually paid and received the revenue for every product they sold that day. They haven't borrowed money. They haven't done any type of factoring or any type of receivables finance. They've actually gotten paid. So if you think about it, business to consumer merchants don't have accounts receivable. They get paid on a daily basis for every product that leaves their hands, or service in the case of a retail service establishment, because they're taking your credit card for payment. Now, today, if you were to buy online, you're also paying immediately. So when you go online and you shop for a good or service, you're always handing them a credit card virtually, right? You're putting in your card number and your code and your expiration date, and you're getting a product. But never does the merchant give you the product without getting paid. Even if you're not paying your Amex bill for another 30 days, that retailer is getting paid immediately. So again, they don't have to wait to get paid. They give you a product, they get paid. If you do leave a store without paying, that's called stealing. It's frowned upon, but it just isn't the way that commerce happens in a B2C environment. So if you're walking out of the store without paying, you're probably on your way to wearing an orange jumpsuit. But let's look at business to business companies, because that's actually the larger part of the economy. And that's the world that I come from. You typically deliver your good or service. If it's a good, it probably leaves your warehouse in boxes on some type of shipping container or truck. And with that box goes an invoice. That invoice tells the customer how much money they owe, and it tells them when they're supposed to pay it. Typically, it'll say net 30, net 60, net 90, etc. So in a B2B environment, you are almost always giving the good or service to the customer, and you're not receiving payment until sometime in the future. Instead of receiving payment, you get what's called an accounts receivable. Now, I don't know about you, but I've tried to pay bills with accounts receivable. It doesn't work. So having this asset called accounts receivable can in some ways be a burden to your company, because you can't use it to run your business. You can't use that as quote unquote working capital. It doesn't work for you. Unfortunately, your capital is in someone else's account and it's working for them instead of you. And if you're lucky, you actually get paid when the invoice says. But long ago, I realized that I could write net never on an invoice, because it's simply a suggestion, and the customer is really going to pay you when they feel like it. Sadly, not usually within the time that you put on the invoice. And I will tell you, we've worked with hundreds of businesses with thousands of customers, and the average net 30 invoice gets paid in 65 days. So unfortunately, that is the rule, not the exception. So at the end of the day, timing is everything. It's not just about, is your product or service profitable, but what is the timing between when you deliver the good or service and when you get paid? If you're a retailer, it happens the same day. But if you're in the business to business world, that's usually not the case. You're usually having to deliver the good or service and then wait till some period in the future before you get paid. Everyone likes to say cash is king. And I often think about the fact that if cash is king, flow must be queen, because my money in your checking account is not doing me a whole lot of good. So not only is the cash important in the word cash flow, but the word flow is important because it has to flow to you. We as small business owners become so accustomed to recognizing revenue but not receiving it that we end up putting ourselves in the position to be the free bank. And so let me tell you a story about how this problem became obvious to me. So about 12 years ago, 15 years ago now, I had started a children's product, which was a spill-proof bottled water for kids. And I was selling the product into small retailers, small distributors. And when I would deliver the good or service, they would almost always write me a check or hand me a credit card. Until about a year into the business, I started selling large orders, truckloads of product. into large retailers like Whole Foods, etc. And for the first time ever, what I realized is that I would deliver this truckload of product and I would send an invoice and then I would wait. And the 30th day would come and a check would not. Another order would come in, but that didn't help me because I couldn't pay my vendors in order to make the next order. And so I was talking to some bankers one day and they said, oh, well, you just have a working capital problem. Now, I'm an engineer by background, not a banker. And so my response was, well, I don't want one of those. How do I get rid of it? And of course, their response was, well, you should just get a loan or a line of credit. Now, as an engineer, I was taught that you always question assumptions. And it seems strange to me that the answer would be just so obvious that I should get a loan or a line of credit. I also thought it was weird that they said, oh, you have a working capital issue, just like they would say you had salad for lunch. It's as if everyone has this. Well, if everyone has this problem, then why can't someone find a solution? And what I realized is that you really have to think about the source of the problem before you just run out and get a loan or a line of credit. And so this chart shows the way that we think about a business's operation. And obviously this is very simplified, but it does get the point across. So in the normal course of business, every day when you run your business, you are managing the flow from left to right, and then hopefully the feedback loop that comes back around to the left. Meaning you sell a good or service and payments come in. That can be in the form of cash, some cash equivalent, a check, a credit card, ACH wire, however it comes in. Revenue is coming into your company in some form, hopefully sooner rather than later. When you get those dollars, you operate your business. That's your working capital. Now, some of those dollars will leave your company in the form of expenses. Of course, you have to buy raw materials. You have to pay your staff. You have to potentially acquire equipment or facilities. And hopefully more than less stays in your business as cash in the company. Those dollars go back around to make the next product so that more money can come in. The challenge many of us have is when that left to right flow gets backed up, people around us, great advisors like our accountants, our bankers, et cetera, say, oh, you have a working capital issue. You should go get money. And unfortunately, what they do is they tell us to either go borrow money, which is up top on this chart, or to go sell equity and bring in more investors. The most expensive capital you will ever use is equity. So that should be sort of the last piece. But even debt is not necessarily the right solution, because if the problem is that the flow has backed up from left to right, pulling money from the top or the bottom in the form of debt or equity may cover up the pain point, but it is not solving the problem. You still have a blockage. What you really need is liquid Drano for your business. But unfortunately, if you borrow that money or you take in equity, you don't feel the pain anymore, but you haven't solved the problem. It's sort of like I hurt my knee and it's swollen, so I take Advil and it doesn't hurt me anymore, but my knees still hurt. And so I started to think about how do we truly solve the problem and get rid of the blockage altogether. There are appropriate times to use debt and equity, but you have to make sure you're using the right type of capital at the right time for the right use. So let's break this down into a couple of different parts and see when the right time is for the right type of capital. Now, sometimes you have a working capital issue because the money that you need to spend to get your product or service made has to move out much faster than you can bring money in. Perhaps you have vendors that require you to prepay. Perhaps you need to go out and buy a piece of equipment to even make the product. Obviously, in that case, unless you get some type of equipment financing, you would have to spend money in order to make the product in order to make money. So in the event that you have to spend money on facilities or equipment, or maybe you have to purchase the raw materials before you can even make the product. Maybe you have to build up inventory before you can even take an order or sell it. Maybe you have to hire staff in order to make the product or deliver the service so that you can get paid. And in any of those cases, if your suppliers are not willing to wait to get paid later, if they won't give you credit, then you may end up with a working capital issue. Now, if that is your issue, then getting a loan or a line of credit is actually a very good solution because you're going to borrow some dollars. Those dollars are going to stay in your company. They're going to go into that piece of equipment. They're going to go into that inventory. They're going to go into those raw materials. And at some point in the near future, hopefully not the far future, you're going to take those materials that you've made and turn them into revenue so that you can pay back the line of credit or the loan. In the case of some type of facility or equipment, you would probably want to use a term loan because you want the loan to match the time horizon of the piece of equipment. So if it's a long-term piece of equipment, meaning it's got a long-term life like a facility, then you're going to want a longer-term loan. However, if it's inventory, if it's something really short-term that's turning every couple of days or weeks, then a line of credit may be more appropriate. Or you may decide that it does make sense to raise equity for something like a facility or some type of long-term asset, or to hire the staff that you need to deliver that service. So if this is the side of the flow that's causing your blockage, then these solutions, which are the solutions that everyone tells you to use, may in fact be a very good solution for you. But let's look at the other side. What if the flow is blocked, not because you have to go spend money up front, but more because your customers are taking longer to pay? The money is slower coming in, and you have to deliver the product or service before you will ever get paid. In this case, and the way that you know if you have this problem is if you have accounts receivable that is greater than 0. Remember, we said if you're a retailer and the minute you sell a product, you get paid by credit card or with cash, you don't have accounts receivable. But if you're having to send your product out and then wait to get paid, the problem is on this end of the blockage. You have an accounts receivable that's greater than 0. It may be that your customer simply takes some time to approve or process the invoice. That in and of itself can take days or weeks, or sometimes even months, sadly, if your customer's really big. Maybe the customer is demanding extended terms. There are customers who will not do business with you if you won't give them net 90, or I'm afraid to tell you, but some companies are even going to net 120, which means you're going to deliver a good or service and you are not going to get paid for at least 4 months, probably 6 months, to be honest. Sometimes your customer just says the check's in the mail. Now, I don't know. It seems that the Postal Service has the complete inability to find small business mailboxes. They can, however, find your house to deliver a bill. But for whatever reason, customers will use this delivery of checks as a way to delay payments a few more days. And then in the worst of all cases, your customer could actually just not pay. I'll admit, when I had my children's business, there were products that I shipped coming off of a big trade show where I got this new customer that I was so excited about. And I would ship the product and I would actually not get paid. Now, there's not a business owner out there who can honestly tell you they've ever not been stiffed or not paid by someone. So that is always a risk, even when you're dealing with large companies. They might just dispute something to see if you'll give them a discount or give up on the money. Now, if this is your problem, the solutions that are out there are you could require a credit card for payment, and that would solve the problem. I actually used to do that when I was at trade shows. I would require that customers gave me a credit card so that the minute I shipped the product, I could charge their card. That way I would get paid immediately, and when they paid wouldn't be my issue, and if they didn't pay, that wouldn't be my issue. That's between them and American Express. You could also require your customers to prepay you, like a deposit or a down payment, or you could require that they pay you on delivery. Usually either that means you're physically delivering it and you can collect a check, or it means you're going to require a credit card. But as you and I all know, sometimes when you start selling to larger customers, they simply won't pay you with a credit card and they won't prepay. And you have the choice of either walking away from the deal or the business or allowing them to take some time to pay. If that's the case, then there is a new tool called a Now account that allows you to get paid immediately as if your customer had given you a credit card, even though they haven't. And that solves your problem because the minute you deliver the good or service and you send them the invoice that tells them they can pay in the future, you can get paid immediately so you can go back and pay your team, pay your vendors, etc. So let me tell you a little bit about Now Account, and then we're going to open it up for some questions. If you think back to that very first picture I showed you, that black and white picture of the merchant, in most cases, a merchant will gladly take a credit card for payment. The reason for this is it feels almost like cash. So when you walk into Starbucks and you swipe that card for payment, or you walk into your local department store and you hand them your Visa or Amex, they're getting paid immediately. When and if you pay your Amex bill, it's not their problem. So they're off growing their business. You actually like using a credit card because you bought yourself 30 days of float, meaning you don't have to pay the bill for 20 or 30 days. So the credit card works extremely well in the business to consumer world. However, in the B2B world, the reason the credit card doesn't work well is if you're the business that's selling a good or service, you would gladly take a credit card for payment and pay your 2 to 4% fee to get paid immediately and have no risk on your customers. However, if I were to ask your customer what do they prefer, they're always going to say, send me an invoice. Why? Because it's free. Because when they get your invoice, they know that they can pay it whenever they feel like it, and there's really not anything you can do. But if they paid you with a credit card, that's not the case. Because the minute their bank statement comes due, if they don't pay it on its due date, they're going to get assessed interest and penalties. Now, you can try to charge your customers interest. I did that once because everyone told me to. And the reality is it's not worth the ink you printed on. You can say 210 net 30. The reality is they're going to take 30 days or 60 days, and they're going to take that discount regardless. So with Now Account, all we did is connect the dots. We created a payment system that allows you as the seller of the good or service to choose to get paid immediately. It's not a loan. It's not factoring. It adds no liability to your balance sheet. You deliver the good or service to your customer and you send them an invoice. You then put that invoice on your Now Account and you get paid immediately minus a flat 3% merchant fee. It feels exactly like taking a credit card. Your customer still gets their invoice. They still pay when they feel like it. They still make the check out to you, but they mail it to a PO box that happens to be Now Accounts. So from your customer's perspective, nothing changes. They still procure the same way, contract the same way, manage accounts payable the same way, but you have already been paid and you're off growing your business. So for the first time ever, you can look almost like a retailer in that you don't have any accounts receivable. It's been completely eliminated. You can get paid immediately and have no liability on your balance sheet. So when you need to go down to the bank to get that loan for the equipment or the facilities, you're going to have a balance sheet that rocks. In summary, I want to give you 5 tips for how to really think about managing your cash flow. First and foremost, identify the cause or causes. If what's causing your working capital issue is that your vendors are requiring you to prepay, then perhaps a line of credit or a loan is a great solution for you. Also, you could actually have your vendor get a Now Account, because when they then invoice you, they're going to get paid immediately, which means you don't have to prepay and you can wait and pay when your customers eventually pay. Number 2, look at the full ecosystem of players. All too often, we get ourselves in a pickle where our vendors need to be paid immediately, but our customers aren't paying, and we just start to panic and we grab the first capital we find. We go get that loan or that line of credit that we found on that online lender that was willing to approve us in hours or minutes. The problem with that is you didn't take the time to look at all of the players in your ecosystem and how they might help you solve it. For example, if your customer needs 30 days to pay, you could go to your vendors and ask if they would give you net 45 or net 60. I actually did that with my children's product, and many of my vendors were willing to do that. You might also go to your customers and see if there is an incentive for paying quicker. You also might go to some of your partners, some of the people that you work with in delivering that good or service, and see if there's a way that they could help on that as well. So before you just rush and grab the quickest dollar, make sure you've looked at all of the options. You've identified the causes and you've looked at the options. It might be that you have both problems, meaning you have to pay your vendors immediately up front and your customers are taking a long time to pay. In that case, what might make sense is for you to get a line of credit on your inventory or get a loan on some of your equipment, but then also use Now Account as a way to get paid faster. So it's not an either or. Now Account, just like the credit card, is a payment system that works with all of your other solutions. Number 3, make sure you're using the right type of money at the right time for the right use. If you get that wrong, your company becomes a hobby. We all have those. They cost a lot of money and they don't make a dime. So when you think about the right type of money, make sure that the type of money has the same time horizon as the use. So if you have a long-term capital need, make sure you're using longer-term capital, like a longer-term loan or equity. If you have a shorter-term need, make sure you're using a shorter-term solution. Then think about how you fund your company differently than how you run your company. So if you go back to that chart where I had the left to right flow, and then you had debt and equity on the top and the bottom, how you run your company is left to right. You do it every day. How you fund your company, that's the vertical. That's the debt and the equity. Don't confuse the two, because if the problem is a day-to-day transactional problem, you're better off using a tool like a Now Account or a credit card to solve that daily transactional problem. Then use the bank or equity solutions to fund your company for things like purchasing equipment or a facility or a big capacity increase. And then number 5, make sure when you look at capital, you don't just look at the face cost of that capital, because each of those solutions has a cost of money, has a cost of risk, has a cost of administration, and may in fact restrict your flexibility. For example, you can draw on a line of credit, but if the customer ultimately defaults, that's still your loss because you weren't covered on the cost of risk. Or you might use a solution, but you're still having to do all the administration, and that's really costly. Maybe if you're smaller, you'd be better just completely eliminating accounts receivable and using a virtual AR solution like a Now Account to not have to deal with the cost of administration and part-time bookkeepers, etc. And most importantly, as a fast-growing business, make sure you keep flexibility, because one of these solutions does not solve everything. So if you look at a solution and they tell you you can't use anything else, run as fast as you can, because you should preserve the flexibility in your business. If you're interested in Now Account, you can find us at nowaccount.com. And what I wanted to do now is we're going to answer a few questions, but first I'm going to tell you the results of the polls that we put out. The first question we asked is, when I have to wait to get paid, I either A, can't grow as fast as I would like, B, I lose sleep, C, I can't pay my vendors, or D, all of the above. A third of you said the biggest problem is you can't pay your vendors. Believe me, I have been there. And nothing hurts a vendor relationship like not being able to pay them. So not only do you have the stress of, sort of being in default on your payments, but you're also ruining a relationship that you probably need as you grow. And then 2/3, 67% of you said all of the above. It's exactly what I felt like when I had my children's product. In fact, on the losing sleep one, I realized that I could probably market Now Account as a sleep aid and charge double, because most of us do lose sleep every night, worried about being able to pay our team and our vendors. So the second question we asked is that about most of my commercial customers, 75% of you said that they take 30 plus days to pay. So as I mentioned earlier, it's not the exception, it's the rule. And if you go into business thinking that you're going to get paid immediately, or that you're even going to get paid in 30 days, you're going to have a rude awakening. I'll be honest with you, I had mine in my car after I dropped my child at school, and I was crying to myself about why I didn't know that and how stupid I was to not have known that ahead of time. So now you know it's going to take longer than 30 days to get paid. And then the last one was, if I could get paid immediately, I would. 20% of you said you would have no AR to manage, which you don't like doing anyway. So you'd prefer to just have no accounts receivable, like our retail friends. 20% of you said you could take buying discounts. So it's interesting. We have clients that use Now Account that have figured out that if they can get paid immediately, they can turn around to their vendors and either pay faster and take a discount because they'll offer them maybe a 4 or 5% discount if they pay in 10 days, or they can buy larger amounts and get buying discounts because they can pay in larger chunks. And then 60% of you said all of the above. So you would not only get rid of your AR if you could, you would take buying discounts from your customers, and you would eliminate the risk of not getting paid so you could grow faster. That's what all of us want. We all went into business to grow, not to sit there and tread water, right? That's not any fun. So let me answer a few of these questions that we've got coming in. I feel like I'm like in the mailroom. I've got these little questions coming in. Okay, so we have a question from Doug. What's the difference between now and factoring? And that's a great question. It's something we struggle with. We call factoring the F word in our office because it's a solution that's been around for so long, but it's unfortunately morphed into something that's actually quite painful for small businesses. Larger companies use it quite well, but for most small and mid-sized businesses, if you are factoring, there are 5 things that are different from Now Account. Number 1, you are having to book a liability, even if it's a contingent liability, on your balance sheet at some point. This straps your balance sheet with debt, which means if you needed to go in and get a facility to help with equipment or inventory or some of these other things, you wouldn't be able to. So the facility that helps you grow initially becomes the limiting factor to your growth. The second thing that's different is in factoring, your fee is variable, which means if your customer pays immediately, then you're going to pay some fee, let's call it X. But if your customer takes longer to pay, as we know they all do, then your fee is going to go up exponentially. It's sort of like interest. It compounds. The problem with that is you don't control when your customer pays. That's what created the problem in the first place. And so you don't control the fee that you're paying the factor. And so when you do a transaction, you don't actually know the fee until the transaction's been done. And if you're like me and like every other business owner, we love it when we get the rare good. We can deal with the bad. We can even deal with the ugly, but it's the unknown that kills us. It puts us out of business. It makes us miss payroll. So liability on your balance sheet, variable pricing. Now Account is a fixed one-time service charge. So once you put the transaction on your Now Account, you pay that fee and you're done, just like you would have if they'd given you a credit card. The third thing is with factoring, you typically have to sign a term contract, meaning that for the next year or 2 years, you have to use that factoring agreement. Fourthly, when you're in that contract, you have to give them all of your invoices. And that constrains your flexibility because what if a customer offers you a credit card? You should take it, but you can't if you're using a factor. With Now Account, you don't sign a term contract. You use it when it makes sense for you. And if your customer is willing to pay you with a card or hand you a check on delivery, you should take it. Use Now Account when your customer requires you to give them 30 plus days to get paid. And then the last one is with factoring, you typically have to send a notification to your customer that you have sold that obligation and they are directed to pay the factor. Now, in some industries, it's common and your customer won't mind. But in most industries, if your customer is told to pay somebody else, they start to worry about your sustainability and they're already looking for another supplier. So with Now Account, you still deal with your customer, you still send the invoice, your customer still makes the check out to you, but it goes to our PO box. So your customer really feels like they're still dealing with you, their supplier. So hopefully that answered the differences between Now and factoring. The second question that we have is from Sumita. What happens when customers treat the Now Account like they treat their accounts payable with us? Great question. So first and foremost, the accounts payable folks in most of your customers, when they get an invoice, they schedule it for payment regardless of what your invoice says. That's why I used to joke I could write net never. they will not in the normal course of business realize that you've gotten paid immediately. We will, when you first start working with us, we will confirm that they've received an invoice and that it's scheduled for payment, but we're not expecting your customer to do anything different. We know that a net 30 invoice is going to take on average 65 days, maybe more, to get paid. And we're not doing anything that would cause your customer to change their behavior. What we are doing is the first week of every month, we send out aging statements to all of your customers that you're using Now Account with, but your name is at the top. And it's simply going to tell them what's outstanding 0 to 30, 31 to 60, 61 to 90, and 91 plus. We're going to send those out until an invoice gets 90 days past due. So on a net 30 invoice, we're going to go out to about 120 days. At that point, if the customer doesn't pay and you haven't been able to get in touch with them and there's no sort of status update, we're going to file a claim with our insurance company and they're going to take it from there. So your customer's not going to do anything different because of Now Account. If they did, let's say that we do have partnerships with Coca-Cola and the federal government, and many of them know that their suppliers use Now Account. In fact, they're the ones that promote it. But they don't take longer to pay because what they realize is if we get past that 120 and we have to file the claim with our insurance company, then we're not going to be able to take the next invoice with that customer. So they know that for the Now Account to keep working, they can't get egregiously past due or else it stops working and we're right back where we all started. We know that your customers will pay late. So if it's not that if they don't pay in 30 days, you can't use Now Account. We are shocked when someone pays in 30 days, but it really does work quite well. And what we find is the customers don't really change their behavior just because you have a Now Account. Okay, I have another question here. This is a question from Sandra. What happens if I have a Now Account and my client prefers invoices only? So your client, if you're using Now Account, your client should prefer invoices. If your client is prepaying or paying on delivery, which means you would not be giving them an invoice, then you really wouldn't need to use your Now Account for that one. But if your client wants to get an invoice, that's exactly when you should use your Now Account. So you still send the client the invoice that they've always gotten with the terms that they either are being offered by you or more likely being that they're demanding. And you're going to send them that invoice that says net 30 or net 90 or net 60. And then when they're ready to pay, they're going to pay how they normally would, whether it's by ACH, by wire. We don't take payment by credit card today because usually the reason your customer wants to pay with a card is they want to buy themselves 30 days. But because you're using Now Account, you can give them net 30, you can give them 60, you can give them 90. Shoot, if your invoice says net 30, they're going to really have 120 days. So they don't need to use a card. If you do allow them to use a card, then you're actually double paying. And that's what we find today. You may sell a good or service to a customer, you let them pay you by credit card, and then they wait 30 days and then give you a credit card. You've paid twice. You've paid the cost of that 30 days of waiting, and then you've paid the credit card fee. You could have just used a Now Account, paid the same fee or less than you paid for the credit card, and gotten paid immediately as opposed to waiting 30 days and getting paid. So it's exactly when your customers want to get an invoice that you should be using your Now Account. Do we have any other questions? So Sarah's telling me that we don't. We are out of questions. Now, if you're like me, you're going to think of a brilliant question in about 5 minutes after we hang up. But I do want to be respectful of your time. So we're going to go ahead and end the webinar. If you do have any questions, feel free to email us or reach out. And of course, if you get a chance, go ahead and subscribe to our future webinars. That way you'll always know when the next one is. I'll go ahead and tell you our next one is going to be around sales. And we're going to share with you some really interesting tools that you can use to pay your Salesforce commissions faster, to allow you to take bigger contracts, but to give your customers something they want as well. So we're going to share some really interesting tools that we found that help you grow sales exponentially. And that's all for today. Have a great rest of your week, and we'll see you, if not on Thursday, we'll see you next week.